Hi, folks. Best-selling author and certified tax specialist Navy Dowdy here. Let me give you the quote of the day. Plans are nothing. Planning is everything. You know who that was from? Dwight David Eisenhower, talking about the invasion and liberation of Europe in the Second World War. By the way, probably the only country that I know of anyway in the history of the world who has completely obliterated the infrastructure and everything of their enemies, taken our own money, rebuilt it, and given it back to the people. That's the United States. So I think today let's talk about one of the questions. So I get a lot of questions from my clients. So one of the questions, somebody called me the other day and said, hey, what is this all about with this inverted yield curve? I mean, why do I care? And why do you care about any of this? Because this is what affects your income. You want to have more income? Pay less taxes. You want to have more income? Lose less money in the market. Well, what is this inverted yield curve? All they're saying when they're talking about the inverted yield curve is that the long-term rates, meaning 20, 30-year U.S. Treasury bond interest rates, are lower than the short-term rates. Normally, it wouldn't be like that, would it? I mean, it would make common sense that you maybe would lend money out for a year at one rate, but if somebody wanted to borrow it for 30 years, you'd want a higher rate because it's tied up for 30 years. Well, sometimes what happens is there's inflation going on, or the market's falling apart, or the economy's falling apart. Some big thing is happening, and people are afraid that rates will go up a lot. And that's what's happening now. So they don't want to lock in lending money very, very long term. And so when they have treasury bill auctions that people don't, and treasury bond options, people don't show up for the price that they want. So they have to lower the price. And we say that rising interest rates hurts bonds, lowering interest rates helps bonds. The truth is that those rates are, the long-term rates anyway, are set by the bond prices. So if people won't pay, let's just use an example, a certain price to buy a 30-year treasury bond that would make it yield 4%, well, they have to lower the price. And if you pay less and less and less, that means there's a higher interest rate that you get. And so that's how the rates are really set. Short-term rates are set by the Federal Reserve. Why does this affect you? Because when interest rates go up, money pours out of other things, such as the stock market. If you could make more money lending your money out, and it's certain, let's say to the federal government, there'll be less money that'll go into the stock market where you might lose it. Also, it's harder and harder to do projects. You do a lot of projects. By projects, I mean build buildings, new stores, new apartments, things like that, new houses. Housing starts will drop and have dropped. All the activity that went on in 2000 and 2001 with real estate will slow down. Why? Because it costs more to buy a house, it costs more to build a building. So all that has a tendency to cause money to flow out of the stock market, and the bond market flows into the bond market, flows out of the stock market. And that's what happens. That's the inverted yield curve. Well, why is it such a big thing? Because you're not building, most of you are not out building large commercial buildings. So why does it affect you? Well, all the time in the past, since the Second World War, when we have an inverted yield curve, we have a recession. The big R, the dangerous R word. Remember, they kind of redefined the definition of that. But I think most people feel like we're in a recession now. I don't want to be a doomsayer. Nobody's ever made a lot of money betting against the United States, and I don't think that they will now. Remember, the world usually only ends once, and I doubt that the U.S. government will ever not be able to pay its debts. They may just have to print the money to pay it, but I think they'll always be able to pay it. So how does it all affect you? Well, if you'd like to get on a quick call with me, I can give you some ideas. We'll talk about my process, Smiling Retiree process. 9 simple steps to get from where you are to where you want to be. We'll talk about I'll send you a copy of my key financial data with all the tax things on it, and also a copy of my Smiling Retiree process tax checklist. This all comes through my private family office and through my overall auspices of my untaxable family wealth. Those of you that have been listening to these channels for a while know that what I basically do is manage a lot of money for some pretty wealthy people through my private family office. I've been fortunate enough over the years to do that. And if you'd like to find out how some of the techniques we use for those pretty wealthy people can be used to help and just particularly save taxes, click on the link below and get on a short call with me. I'm Navy Dowdy, and remember, financial fitness can be beneficial to your wealth.